Welcome to RANsquawk's morning briefing for Thursday, the 25th of February 2010. Taking a review of what we've seen so far in Europe, it has been a very busy morning. Starting off with some comments that we saw from S&P late yesterday, saying they could potentially, within a month, downgrade Greece's sovereign rating by 2 notches, which would put it at a junk status. That was released yesterday, but got attention as European markets reopened this morning, and as such the spreads did widen, particularly Greece but also in the peripherals, and we did also see the Greek 5-year CDS also rising quite sharply this morning. That did lead to some risk-averse trade across the board. Some strength in the yen was seen. Stocks were generally weaker at the open of equity cash bourses, and bunds were bid. However, in terms of as the session has progressed, equities have managed to eke back towards the unchanged mark in terms of corporate earnings. One of note from the UK was RBS, who although posted a multi-billion-pound loss for the fourth quarter, they did say that impairments may be beginning to peak now, and their shares have traded higher. They're up around 6% at present. Credit Agricole in France as well, saying that their Greek unit Emporiki has no material effect from the Greek situation. They're also trading up around 4.5%. In terms of some of the data we've seen as well, some decent consumer confidence numbers at the likes of Sweden and also Italy. In terms of the latest unemployment rates out of Germany, they were somewhat favourable in terms of improving job situation, as well as the EU Business Climate Indicator coming in slightly better than expected. As well, given some of the recent comments and the fears that we've had resurface in regards to Greece, what it does appear is that some of the rating agencies may have been spoken to by various EU officials, although that's unconfirmed. They have all come out and pretty much taken a bit of a step back from being as aggressive as they were yesterday. Just taking a recap of some of those comments, Fitch have just been on the wires a short while ago and said that they expect to keep Greek rating unchanged for a few months unless something unexpected happens. And also S&P themselves have come out and pulled back slightly on the rhetoric they made yesterday, saying that despite ratings actions, Greece is still comfortably within investor grade. In terms of Greece themselves, some sources have indicated that new austerity measures will be released around midweek of this year, and in terms of any bond issues that were due for this week, they said that will more likely happen next week, saying that the strikes ongoing in Athens, as well as some of the latest rating agency comments, have prevented them doing a bond issuance this week. In terms of things to come then, we've got the weekly jobless numbers at 1:30, that'll be alongside the durable goods report. We'll also look out for Bernanke. He'll be now testifying in front of the Senate, but again, as we saw yesterday, he's likely to stress yet again that rates in terms of the federal funds rate will remain low for an extended period. And then in terms of US fixed income, we'll look for the $32 billion in the 7-year notes. That'll be at 6 o'clock London, so midday in Chicago.